Hello, mortgage broker community. I'm here today with Rob Chrisman. Obviously, one of the most well subscribed to newsletters. We all read his daily Rob Chrisman newsletter that you can view online also at robchrisman.com. Rob is taking the time today to speak with us a little bit about what's going on in the market, talk about how rate volatility is not only obviously impacting our pricing and the rates that we are providing our consumers, but also how it's impacting lenders as there's been an overwhelming amount of volatility, and we continue to see the dialogue about how rates are not exactly following the Treasury moves and mortgage-backed security moves. So, Rob, thanks for taking the time to spend with the broker community today.
You bet.
So, I guess the biggest storyline that has been ongoing with brokers over the last couple of weeks has been we've seen some huge shifts in the 10-year Treasury, 20 basis point drops per day. This week alone, we've seen the 10-year Treasury drop by 30 basis points in one direction and move up 20 basis points over the last 24 hours. The question that a lot of brokers have, sort of been asking me is, hey, Anthony, why aren't we seeing rates move with the momentum that, the 10-year Treasury is moving? Because historically, if, 10-year Treasury drops by 20 basis points, we'll see a 50 to 100 basis point improvement in pricing, but that's not exactly happening. I've explained some of the issues in the market right now. What are you seeing? Are you hearing anything related to, lender capacity issues or any reasons why lenders might be not able to follow those trends as quickly?
Absolutely. First of all, let me just go on record as saying volatility is nobody's friend, whether you're an originator who's dealing with borrowers who hear about these things in the press and expect immediate results, or whether you are a capital markets person dealing with a volatile interest rate environment and trying to hedge a locked pipeline, or you're a broker dealer who's dealing with volatility. So volatility isn't good for anyone in the business. Basically, I think it's important for for any originator to keep in mind is that the market as it is it's about a $10 trillion. There are about $10 trillion of outstanding mortgage-backed securities. And we as an industry do about 2 to 2.5 trillion for the entire year. That's kind of our ability. And we have the ability to do more, maybe 3, 3.5, maybe 4, maybe 5, who knows, pushing the outer bounds. But if I were to, dump a 50-pound sack of kibble in front of a Chihuahua, the Chihuahua might, gorge itself in this initial feeding frenzy. But after about 5 or 10 minutes, there's still, 48 pounds of dog food left and the Chihuahua is full.
Yeah.
So the Chihuahua looks at this pile of dog food and says, well, I'll eat this eventually, like throughout the rest of the year. I can't eat it all now. So the industry is looking at this huge pile of loans, this huge pile of refinanceable loans. I love it when companies like Black Knight come out with the refinanceable population and everybody starts salivating. It's like $6-8 trillion of refinanceable debt that's out there. The issue is, it's like pushing water through a water hose. You can only do so much at any given time. And I think it's important for originators to remember that we are, despite all the technology, we're in a people business. There are people who are involved in the process. There are appraisers who are backed up. There are underwriters who are already working overtime. There are processors. There are loan originators who are working 7 days a week already to deal with some of this outstanding debt and refinancing it. And so I think that the quickest and easiest way for an investor or a car dealer or a drugstore or anybody to change the supply and demand equation is change the price. Yeah. And that's what you're seeing originators are seeing that from the investor community is like, whoa, wait a minute. I don't have to follow the Treasury market. I don't have to follow Fed funds down 50 basis points. And by the way, just and I know I mentioned this a fair amount in my commentary, but Fed funds don't set mortgage rates. I think a lot of your listeners understand that. But you're right. The 10-year Treasury has dropped significantly. Mortgages have lagged, and it's more purely a capacity issue, and investors and lenders saying, "Whoa, we just can't handle the volume,"
Yep.
and they're getting picky, both with price and with clients. So this is a textbook example of that. It's happened a little bit in the past. Every once in a while, rates will shoot down, and people will say, "Well, why aren't mortgage rates shooting down?" Well, because it takes a while to catch up, and as things settle down and as volatility decreases, we can expect to see mortgage rates, eventually catch up. But going up, going down, going up, going down. It's a tough environment to hedge in, and it's a tough environment to originate loans in, because borrowers are getting all this information too. So it's a tough environment.
You're 100% right, because it really is, everything is relative at this point. So the pain points of the lenders are indirectly the same pain points of loan officers. Loan officers are saying, "Hey, I locked this customer 2 weeks ago at this rate." Customers coming back to me and saying, "Hey, I saw there was an emergency rate cut," or CNBC is saying rates are down. And lenders are sitting here dealing with, loans moving from pipelines and margin calls and those kind of things. So everybody's not in a favorable position in a volatile environment like this. But one thing you did touch on that I think is important is you mentioned, there's a capacity issue here, because realistically, no lender, no matter how scale of a player they are, if they're, Quicken or UWM, nobody's prepared for a coronavirus 10-year Treasury at 0.65. Nobody's staffed at a level that can actually support this capacity. So it's not that lenders are backing off pricing from a, hey, we're just going to go max profits. It really is a reaction to, what they're dealing with coming in the door. Exactly. Got it. Exactly. So one of the other big storylines that we've been following, because it's definitely relevant, and you see, you've covered it in your newsletter, and it's definitely something that we're hearing a lot of feedback from lenders on, and especially the capital markets people, is, what is the impact on servicing valuations going to be at the end of this quarter? On January 1st, the 10-year Treasury coming into the year was at 1.95. Today, before we got started, it was at 0.65. My understanding from what I've, of the, capital markets people I've spoken to is, servicing books are reevaluated on a quarterly basis. So at the end of this quarter, anyone that's holding servicing is going to be subject to a pretty substantial write-down based upon the fact that, lower treasuries mean the value of existing servicing declines, and that's a real financial, burden that the lenders are going to deal with. How does that impact the lenders in the market?
It certainly impacts their pricing, going back to, them not wanting to follow the Treasury rates down. If you have if I told you, Anthony, I'm going to pay you, you're going to be servicing my loan for the next, 30 years, and you were counting on that cash flow, receiving a check from me and then forwarding on whatever it is to the investor, and you collecting that small piece for yourself, and something that you thought was going to last not 30 years, but 8 or 10 years probably, especially rates at 3.25% 30-year fixed rate, it can't go anywhere.
Great. Yeah.
I'm gonna book that servicing, and to me it's worth a point. And suddenly, it's that point goes away, because that loan is in the $10 trillion of mortgage-backed securities that are out there that can be refinanced at a lower rate. And so this asset that you said was worth a point is now has very little value, very, very little value. It's just like, your house burning down, or your car, your 65 Cadillac getting in an accident. Not that you have a 65 Cadillac. You understand what I'm saying? You have this asset, and suddenly it's not worth anything.
Right.
And so companies who are servicing loans are saying, "Oh, holy smokes! The servicing portfolio that we have $1 billion of servicing, and we thought it was worth $10 million, and now that $10 million has virtually vanished within months." And so they are indeed scrambling. It's kind of like running in place. They are hoping, those services are hoping that their origination volume and their origination profits will make up for the loss of servicing value, but it's going to be tough. Like I say, it's like running in place. And so you have companies out there saying, all right, some companies weren't servicing at all, and they're actually better off not servicing, although they will have potential early payoff penalties to pay. But the other companies were servicing and perhaps hedged their servicing, which, hindsight being what it is, was a smart choice. Yeah. But now a lot of companies who thought, I will hedge my servicing portfolio with my production, should rates drop and my servicing values decrease, we're going to have income from all the loans we're going to originate. They're hoping that that's the case. So yeah, you also have this whole servicing play and what is servicing worth. And you have companies now at this point saying, I haven't done any servicing up until now, but gee, if I have a portfolio of 2 3/4 or 3% 30-year fixed rate loans, maybe I'll take a look at it again and start servicing. So there is that thinking. But yeah, the servicing valuation hit that is expected when they do their valuation, but they know that that's coming. That has a huge impact on their pricing, on their daily rate sheet pricing.
And from my understanding, I think one of the common, even before this refi boom really hit its stride, one of the things that we were seeing a lot of dialogue about in Chrisman and IMF is about the pressure of banks kind of pointing the finger at non-banks, saying, "Hey, these guys aren't properly capitalized, or they don't have the liquidity requirements that banks have." So, one of the things that I wonder about as I see this dialogue unfold is, that part of it, which is, if a lender has, $10 billion in servicing or $20 billion in servicing, and that takes a 25% write down, that's not peanuts. That's 1/4. So, obviously that's real capital, and they leverage their servicing as a collateral. It's going to be an interesting period of time here in the next couple of weeks. It's not something to overlook.
Right. That old Chinese proverb, may you live in interesting times. It will be interesting. There's a lot of chatter out there about the inability for some companies to meet their early payoff penalties, for some companies who are servicing to absorb that write down to their net worth. There's chatter about renegotiations impacting the bottom line, going straight to the bottom line for many lenders. And so there is chatter out there that we could see a fair amount of turnover in the mortgage world in the coming months because of all these factors that are hitting them at once.
In your perspective, just looking at this issue, because the other issue that's been a big topic is prepay speeds. Obviously in this environment, prepay speeds are, they're going to go through the roof. Can anyone really justify making changes to policy or the way that lenders are prepaying loans, or when it comes to rates weren't bad last year. I mean, the rates were in the mid threes, and we thought that was really good. This is, in the twos. Is it something that the investor community and the Fannie and the Freddie and Ginnies just have to, make changes based upon the fact that loans are prepaying and it's an industry issue?
Yeah, I would say that it's an industry issue, and it also brings to the forefront the discussion that seems to be popping up more and more with regard to the FHFA overseeing Fannie Mae and Freddie Mac and bringing private money into the mortgage business. Who can withstand a shock like we've seen here recently? I think it falls more under the domain of the federal government being able to absorb something like this rather than private money. If private money were to take a more active role in the mortgage process, or I should say in the mortgage market in general, what would happen in this kind of situation? Could private capital, as they say, take this kind of hit? Or is it more of a federal government issue? I think a lot of people will argue that it's the federal government who have the pockets in order to withstand what Fannie Mae and Freddie Mac are seeing out there. So yeah, there's a lot going on. There's a lot to talk about. It'll be interesting.
Absolutely.
To see what happens over the coming months.
So I guess the last question I have for you today is from a one of the interesting points that I had a conversation with Willie Newman from Home Point yesterday, and one of the things he mentioned was, last year rates were great. It wasn't too far ago that Brexit happened and rates were great just a couple of years ago. Obviously, this year we're in uncharted territory, and some people are saying the market could be as big as 5 trillion. That's big. So
you're stealing my commentary. I received a note from Scott Happ, Optimal Blue CEO. I'm not going to tell you what it said, but Optimal Blue is in the forefront of because they're in the lock process and they are seeing loans come in, and what they're seeing is truly amazing. The volume for 2020. But anyway, go ahead. Tell me what Willie said.
So the question was, that Willie kind of made a comment was like, what does this market look like post, if this goes on for a year? What does the market look after that? Because a lot of consumers are going to be capitalizing on very, very low rates. You would imagine that's going to have long-term, consequences on, refinance behavior. It'll probably have an impact on people's buying habits, whether they move sooner. And then the last part of it is, instead of doing cash out refis like people have been doing, maybe it's home equities. But what are your thoughts on that?
Well, the first thing I think that people should keep in mind is why rates are where they are. They are here not for good reasons. They are here, whether you say the fears of the coronavirus are founded or unfounded. It remains to be seen that markets in general trade on fear and greed. I mean, they always have, they always will, fear and greed. And so right now it's fear. What could the virus have, what impact could the virus have on not only the US economy, but the world economies? When you go to an airport or a hotel, is it half full? The hospitality industry isn't the only thing that's being impacted. So you have this impact on the economy, potential or real. If you get into a dire situation, you will have people who can't afford to stay in their homes. You could see a spike in delinquencies and foreclosures despite only having 2 3/4 30-year fixed interest rate. So with that as a backdrop, I shouldn't even say backdrop. Listeners need to keep that in mind. What could happen here? Why are rates where they are? And is it going to negatively impact our economy for years to come? Are we going to see another 2008 kind of scenario, or could it be worse? With regard to the current crop of mortgages, or the current, whatever you want to call it, about what's being originated right now, I would say that if you think about how you will behave in the future, or if I think about how I will behave in the future, and I've got, let's say I just refinanced and I've got a 3% 30-year fixed rate mortgage, how much lower can they go? I would argue that they can't go much lower in terms of mortgage rates, because if rates really go farther south, you are going to have the impact of the economy influence the way investors think about, gee, do we want to own Rob's mortgage if he's out of a job?
Yeah.
Maybe we don't. Despite having mortgage insurance, or despite a relatively low loan to value, we just don't want to take that credit risk, given the current environment. With regard to if rates stabilize and the economy doesn't go in the tank, in fact, if rates slide up because we find a cure, or it turns out this is overblown, that we're reminded that snakes kill more people than the coronavirus does, or suicides, or whatever it is, and it's just a bad cold, which would be nice.
Yeah.
I think then that you are going to be dealing with millions and millions of borrowers, just like you or just like me, who like our mortgage rate, and we like our home. And in fact, let's buy another one because the payments are so low, so that that second home on the lake that's an hour and a half, 2 hours away starts to look pretty attractive. But the odds are that you and I are going to stay in our mortgage for quite some time.
Yeah.
And the ability to, the rate and term refis will go away. Yeah. If the economy rebounds or does well, then you could get into more cash out refis, HELOCs start to make sense, lines of credit, that kind of thing. So the lending environment shifts away from the rate and term refis more towards purchases and more towards tapping into the home equity. And I think companies that are positioned to take advantage of those are in a pretty good spot.
Yeah, you nailed it, and that's an interesting piece of commentary, because I think that's one of the things that I've had a lot of conversation with wholesale lenders about in the last couple of weeks is making sure that broker market share has increased at a very strong pace over the last 6 to 8 quarters, and it's done that on the back of purchase, and it's really important that momentum continues, because refi markets, are very good when they're here, but from what I've seen, the companies that focus on purchase are ones that are sustainable for the long term.
Yeah, we've been predicting the end of the refi market for 10 or 20 years now. It hasn't happened yet, but rates haven't been down here either. So, like I said, interesting times ahead.
Yeah, I'll leave you with this. This is the comment that somebody said the other day. They texted me and said, it's a once in a lifetime refi moment. I said, that's what I was told 2 times in the last 2 years or 3 years. So I have a feeling that's not the last time somebody's going to be saying those words. But we appreciate your time and obviously your contributions to the industry and your daily newsletter. So thank you very much.
You bet.
I'm grateful, and I know this will be very impactful content for our community.
There you go. Thanks, Anthony.
Thanks a lot. You have a great day.